One of the biggest wealth killers isn't really how much you earn, it's how much your kids lose to taxes when you die. If you don't set up your businesses and real estate the right way, a massive chunk of everything you've built could end up with the IRS and not your family. But it doesn't have to be that way. I've helped thousands of entrepreneurs structure their businesses so they can legally pass on their wealth completely tax-free. So today, I'm going to show you exactly how I do it if I were starting from scratch. So you can preserve everything you've worked so hard to build, and more importantly, set your kids up to go even further. So what are the most overlooked tax traps when transferring a business to your kids? I will tell you, there are a couple of them. The first is when you die, you get a basis step up. What that means is that whatever your basis is, whatever you paid for it, plus the income you left in the business. Okay, that's basically your basis. If you're an S corporation, some kind of a pass-through company, like an S corporation or a partnership. So what you want to do is you want to make sure that the value gets stepped up, your basis gets stepped up. And why is that? Because at some point, your kids may want to sell the business. Well, they don't want to pay tax that they don't have to if they decide that they need to sell the business. Okay, so how do you do that? Well, very simply, you don't want them to own the business from an estate tax standpoint until after you die. Okay, here's why. Let's say that your business has a basis of $100,000. You've left $100,000 in there. You've taken everything else out. So really, you didn't put anything in to begin with. It's $100,000. But let's say it's worth $5 million. If you transfer it to your kids before you die, and then they sell the business, they're going to pay tax on that $4.9 million difference between the value of the business and your basis. What happens if you own it when you die is that basis goes from 100,000 to 5 million, literally overnight. So with the new big beautiful bill, we now have a $15 million exclusion per spouse. So that means if you're married when you die, then instead of a $15 million exemption from estate tax, you have a $30 million exemption. Now remember, there's income taxes and estate taxes. You don't want to pay estate taxes. Estate taxes are 40%. They're pretty much a flat 40%. So once you get over that $15 or $30 million, you're going to pay 40%. So what you need to do is you want to make sure that anything with a low basis and a high value, like your business, stays in your estate. Okay, you want it to stay in your estate when you die so that you get that basis step up. You only want to transfer assets out of your estate when they're either high basis, low value, or you're over the $15-30 million exemption threshold. Now, there are ways to do this, and it's by using trusts. And trusts are really good for estate planning, gift planning, and family planning. They're really good for that. They are not good for business. In other words, you can't get out of income taxes on your business just by a trust owning it. There's some falsehoods out there on that. But what you can do is you can actually have it in a trust. It stays in your estate, but it automatically transfers to your kids, and they can even maintain the S corporation status of it. So there are ways to do this. You do need to sit down with a really good tax advisor on this one, because as they say, the devil is in the details, and you must dot your I's and cross your T's. So here's the thing, and it's not just trust. So you got to combine trusts, which includes your living trust, right? Your family trust, which that doesn't have a tax consequence, but it makes it easier to pass on your assets to your heirs without probate. You need to combine that with your entities, like your S corporation or your partnerships or your LLCs that are taxed as S corporations or partnerships, or even your C corporations. Okay, see, these things work together. You can't just think about estate taxes, because then you'll miss that basis step up. You can't just think of income tax, because then you could pay estate tax. But here's what's really cool. What you can do now is you can actually set up your estate plan with some flexibility so that, for example, while your kids are little, one thing happens, but as they get older, something else happens. And then when you die, even something different happens. So remember, a trust is simply a contract between you, the trustee, and the beneficiary, let's say your children. Okay, so you want to make sure your estate planning is set up and your income tax and your planning is set up so that they work together. And this is something that is missed, I would say 99.99% of the time. CPAs tend to focus on income tax and they don't understand the estate tax. And estate planning attorneys focus on estate tax and they don't understand the income tax. So here's the thing. Can you really eliminate capital gains taxes and estate taxes? And the answer is yes. You can do both. You can have that basis step up. You got to stay under 30 million. But let's say hey, my estate's like 50 million. Well, congratulations. I think that's awesome. We can still do that, okay? Because we have what's called some discounts. We can do some really sophisticated planning, but that is something where you do need a team working together. This is, as my friend Robert Kiyosaki says, investing is a team sport. And this is an example of that. You must have the CPA, who's the income tax planner, the attorney, who's the estate tax planner, and you also need a different attorney that's an asset protection planner. So you actually need an entire team working together to help you. Now, is it worth it? Is it worth saving, say, 20% or 30% on the value of your business when you die? That would be the capital gains taxes. Is it worth saving 40% of estate tax on the value of your business when you die? 40% of $5 million, that's $2 million. Is it worth it to you? That's the question. And that is the question you have to answer. What my job and every really good tax advisor, like our TFW advisors, every tax advisor, our job is to give you a choice. But unless you understand what the possibilities are, you never have a choice. Now, if you've ever wondered how wealthy families keep control of their money generation after generation, it all starts with how they structure their finances from the very beginning. The best part is you don't need to be a billionaire to do it. And in fact, it works better if you're not a billionaire. In my free masterclass, I'll walk you through how to use the tax law to protect your assets, reduce your taxes, and set up your family for long-term wealth, all 100% legally. Click the link below to join, and when you refer a friend, you'll be entered to win a personal strategy session with me, plus a few surprise bonuses we put together. Just don't wait. These seats are filling up very fast, and we keep the group small so we can really go in depth. So here are a couple other questions that I get from time to time. First is, when should you start thinking about transferring your business to the next generation? Well, I would go a step further. When should you start thinking about transferring your business at all, whether you're going to sell it or transfer it to the next generation? I would tell you it's when you start the business. Here's the only thing we know. Life will change. Your life changes, my life changes every single day. And so we need to actually set it up, and I would suggest we want to set it up so that it can run without us and it can be transferred at any time. Now, it may mean that we don't transfer it. It may mean that we only work like 5 hours a week in the business like I do with my CPA firm. Well, that's pretty nice to be able to work 5 hours a week. Now, I do have other businesses. Because I work 5 hours a week in the CPA firm, I can do these other businesses. So whatever you want to do with your life and whatever you will end up wanting to do with your business, you really need to plan now, absolutely right now, so that it can be transferred. So that's part of the business itself. One of the challenges was with most business owners, they aren't thinking about selling a business until they're tired of the business, and then it's too late. You've really got a plan. Now, you may never sell a business. You may transfer it to your children, but doing the planning now, and the reality is, even if you don't end up trading the business to your children, you may want to transfer the value of the business to the children. So all of that can be set up. That is the great thing about estate and income tax planning, is the flexibility. Here's an interesting one for you. When it comes to tax, what's the difference between, I don't understand the question, what's the difference between giving and gifting? I'll have to go to the next one. So how do you make sure your kids inherit not just money, but actually a whole tax-free system? That is such a cool idea. So they are actually set up themselves for tax-free wealth. What a blessing that would be. My mother always told me, she said, look, my job is to give you roots and wings. And the roots are all of the education that you get so that you have wings to fly and you can really take off. Wouldn't it be great if we set our kids up so that they had a system of building tax-free wealth, so that it was already set up with the proper entities, not just the trusts, but actual the business entities, whether it's the S corporations, the C corporations, the partnerships, the LLCs taxed that way. All of these work together. There are no good and bad entities. There are only good entities for certain things and bad entities for certain things. Okay? Every entity has a positive use and a negative use. So you've got to be very careful about that. So the biggest mistake wealthy families make with estate taxes, and that is they think about it too late. That is the biggest mistake they make, because here's the thing. We have $30 million in a husband and wife available to us to transfer tax-free. Well, what if we wait until our wealth is 50 or 60 million? Now it's a lot harder. But what if we started when we were at 10 million? Could we have transferred some of that value out of our estate before it ever gets to the 50 million? Absolutely. Because again, what we know is the only thing certain in life is change. Things will change. So we need to set up the trust. We need to set up the income tax planning, the entity planning, so that they can change, so they are flexible. So if you want a clearer picture of how the wealthy legally keep more while they're alive, this next video will show you how. It walks you through you the exact strategies I use with my clients to protect and grow generational wealth. Click the video on the screen or down below, and I'll show you how to start using these same tools no matter where you're starting from.